A British company just paid $3.2 billion for a Louisiana oil company that you've probably never heard of. And the way they structured this deal tells you everything about where the smart money is going in 2026. In the next few minutes, I'll break down this deal in plain English, and you'll learn why a UK company is betting big on the Gulf of America, how a billion dollar deal actually gets done like this, and what deep water oil means for energy prices and American jobs. I'm going to explain some Wall Street terms that you might hear on the news and try to actually make them make sense. I'm Mark Roach, petroleum engineer, deal maker, 30 years in this business. This is FutureWise Energy, an independent channel where I don't just report energy news, I try to explain why it matters to regular people. In this deal, it matters. Well, let's start with the headline. Harbour Energy, the UK's largest independent oil and gas company, announced on December 21st, 2025, that they're buying LLOG Exploration. That's a privately held deepwater operator based in Covington, Louisiana. The price tag, $3.2 billion. Now, $3.2 billion sounds like a big number because it is. To put that in perspective, that's roughly what it would cost to build 6 brand new NFL stadiums or 32,000 average American homes. But here's what makes this deal even more interesting. It's not just the size, it's how they're paying for it. And this is where we get into some Wall Street terms that sound complicated, but they really aren't. So how is Harbour paying for this? 2 ways, cash and stock. The cash portion, that's $2.7 billion. That's pretty straightforward. Harbour hands over actual money when the deal closes. And then the stock portion is $500 million. Instead of more cash, Harbour is giving LLOG's owners about 175 million shares of Harbour stock. Think of it like paying for a house party in cash, and partly by giving the seller a stake in your business. So when you add those two together, 2.7 billion cash plus 500 million in stock, you get what Wall Street calls the enterprise value. Well, that's just a fancy way of saying the total purchase price for the whole company. Now, here's where some details matter. And if you follow deals, LLOG's owners won't be able to sell 70% of their new Harbour stock for a full year. Wall Street calls this a lockup period. So why does this matter? Well, it prevents the sellers from immediately dumping their shares and crashing Harbour's stock price. It also shows that LLOG's owners believe in Harbour's future. They're willing to be locked in as partners, not just cash out at the end of this deal. So after the deal closes, LLOG Holdings will own about 11% of Harbour's total shares. So they went from owning 100% of LLOG to owning 11% of a much bigger, widely traded international company. And before we go further, let me explain what LLOG actually does, because this matters for understanding why Harbour wanted them so badly. LLOG is what the industry calls a deep water operator. Let me break that down. When you drill for oil in the ocean, there are different categories based on how deep the water is. Shallow water, that's maybe a few hundred feet deep, close to shore. Then there's deep water, generally anything over 1,000 feet. And then there's ultra deep water, and that's over 5,000 feet. LLOG operates in deep water and ultra deep water. One of their fields, called Shenandoah, sits in water that's about 5,600 feet deep. To picture that, if you stack the Empire State Building on top of itself 5 times, you'd still be underwater. Drilling in water that deep is incredibly complex. You need massive floating platforms, specialized equipment, teams of highly trained engineers. It costs billions of dollars to just get started, but there is a payoff. Deep water fields, they often contain huge amounts of high quality oil. And that's why companies take the risk. Let me give you LLOG by the numbers because these are impressive. LLOG was founded in 1977. That's 48 years of experience in the Gulf. And they're currently producing about 34,000 barrels of oil equivalent per day. Well, barrels per day is how the industry measures production in that's a barrel is 42 gallons. And that's about the size of a standard oil drum. And well, here's the growth part. They expect to double that production rate to 68,000 barrels per day by 2028. That's not a guess. I mean, they have wells planned and the infrastructure is being built. Now, about those reserves, LLOG has what's called 2P reserves of 271 million barrels of oil equivalent. Well, let me explain what that means. In the oil business, reserves are categorized by how confident companies are that they can actually produce them. I mean, these are underground, and there's a lot of technical assumptions that have to be made to estimate how much is there without actually knowing for sure. So proven reserves, or if those numbers are considered proven, then that means there's a high degree of confidence that those barrels will be recovered at that number. Probable reserves, well, that's a different type of number. That's a number that they're reasonably confident in, but they don't have 100% confirmation. So when you add those two together, how confident companies are that they can actually produce them. Proven reserves, that's oil they're highly confident exist. And then probable reserves, that's oil they're reasonably confident about, but haven't 100% confirmed. When you add proven plus probable together, you get 2P reserves. 271 million barrels at their current production rate gives LLOG a reserve life of 22 years. That means they could keep producing for over 2 more decades without finding any new oil. And that's an unusually long runway in this business. One more number that matters. Their operating costs are only $12 a barrel. In an industry where many companies spend $20, $30, or $40 to produce a barrel, that's remarkably efficient. Low-cost producers survive when prices crash. High-cost producers go bankrupt. LLOG is built to survive. LLOG operates 3 major oil fields that produce about 90% of their oil. Let me walk you through them. First, Who Dat? I said that right. Yes, that's the actual name. A nod to Louisiana Saints fans. It's their oldest field. It's producing about 14,000 barrels a day. They've been working this field for years and it still has upside. There's oil reservoirs beneath the ones they're still tapping. The second field is called Buckskin. This was LLOG's first deepwater project that started producing in 2019. It currently is at 10,000 barrels a day with only 4 wells online. And they plan to more than double production by adding more wells. Third, Leon Castile. This is their newest development. It just started producing in October 2025, so literally just a few months ago. It's already hitting 14,000 barrels a day. And this one uses a brand new floating production system called Salamanca. And here's what's remarkable. LLOG has been responsible for 1 out of every 3 oil discoveries in the entire Gulf of America, or the Gulf of Mexico, before Trump changed the name, going back to 2014. That's an incredible track record. They're not just producing oil, they're finding new oil, and that exploration capability is worth a fortune. Now let's talk about the money. How does a company actually fund a $3.2 billion acquisition? And that's where, well, everything kind of gets a little more interesting. And let me explain some terms that you might hear on financial news. So Harbor, like I said earlier, isn't just writing a check from their bank account. They're using a combination of 3 things. First, a $1 billion bridge loan. Well, what's a bridge loan? Well, think of it like renting an apartment while you wait to close on a house. It's temporary financing that bridges you from now until you can arrange permanent long-term financing. Bridge loans typically have higher interest rates, so companies want to pay them off quickly. Second, a $1 billion term loan. Well, this is traditional bank financing. You borrow money, you pay it back over a set period with interest. It's like a mortgage for a company. Then third, $700 million from their existing cash and what's called revolver capacity. A revolver, that's short for revolving credit facility. It's basically a corporate credit card. The company has a credit line that they can draw from when needed. So add it up, 1.7 bridge plus 1 billion term loan plus 700 million cash equals $2.7 billion. And that's exactly the cash portion of the deal. And the financing is structured carefully to maintain what's called an investment-grade credit rating. Credit ratings for companies work kind of like your personal credit score. Investment grade means banks and investors consider you a safe bet. If Harbor's credit rating dropped, borrowing money would become much more expensive. So they've designed this financing to stay in this safe borrower category. Let me explain a few more deal terms that you might encounter in news coverage. HSR Act clearance. Before big deals close, the U.S. government reviews them to make sure they don't create unfair monopolies. HSR stands for Hart-Scott-Rodino. It's a law from 1976, and this deal needs HSR approval before it can officially close. Escrow deposit? Well, Harbor put $100 million in escrow. That means the money is held by a neutral third party. It's like earnest money when you buy a house. It shows LLOG that Harbor's serious. If the deal closes, this $100 million gets applied towards the purchase price. Long stop date? Well, this is the deadline. If the deal hasn't closed by July 1st, 2026, either side can walk away. It prevents deals from dragging on forever while everyone waits for approvals. Expected close date? Well, it's late in the first quarter of 2026, so probably February or March. That's just a few weeks away. So why does this deal make sense? Let's break it down for both sides. For Harbor, the buyer, this deal accomplishes several things. One, it lets them into the U.S. market. Harbor operates in the U.K., Norway, Argentina, Mexico. Adding U.S. Gulf of America production makes them a truly global player with 5 major regions. And 2, growth. Harbor's goal is to produce 500,000 barrels per day by the end of the decade. LLOG's production, especially with that planned doubling, helps them hit that target. 3, better reserves. The deal increases Harbor's total 2P reserves by 22%. More reserves means more future production, which means more future revenue. 4, higher quality oil. LLOG's portfolio is about 80% oil compared to natural gas. Oil typically sells for more than gas on an energy equivalent basis. Plus, LLOG's low operating cost of $12 per barrel improves Harbor's overall profit margin. 5, tax efficiency. U.S. tax structures, particularly for offshore oil, can be very favorable. This deal actually lowers Harbor's overall effective tax rate. For LLOG, the seller, here's what they get. 1, a massive payday. LLOG has been private for 48 years. Private companies can't easily sell shares on the stock market. So this deal gives LLOG's owners, including private equity backers, a way to finally cash out. 2, they still have skin in the game. That 11% stake in Harbor means if Harbor's stock goes up, LLOG's former owners benefit, and they're not completely walking away. 3, LLOG, well, the brand that they created survives. Harbor is keeping the LLOG name for their Gulf of Mexico or Gulf of America business unit. That matters for reputation and for employee morale. 4, management staying. Philippe Lejeune, LLOG's CEO, is expected to continue running operations. The team that found all those discoveries, well, they're not getting fired. They're getting a bigger platform. One more thing worth mentioning, the deal involves what's now officially called the Gulf of America. And you may remember, as some of you do remind me of, as I forget on occasion, that President Trump signed an executive order on January 2025 that renamed the Gulf of Mexico to the Gulf of America. Federal agencies are required to use the new name. Harbor's official press release does use the Gulf of America throughout it because you're dealing with U.S. regulators and federal leases, and you use federal terminology, therefore. But here's the reality. Most international organizations, media outlets, and even the oil industry's own historical records still use the Gulf of Mexico. Decades of geological surveys, academic papers, and lease documents reference GOM, Gulf of Mexico. The name change is official for U.S. government purposes, but the rest of the world hasn't necessarily followed. LLOG just won 11 additional leases in what the federal government called the Big Beautiful Gulf 1 lease sale. Yes, that's the real name. More exploration acreage for Harbor's newly acquired team. Who advises on deals this size? Let me give you a quick peek behind the Wall Street curtain. On the buyer side, Harbor, well, they had J.P. Morgan Cazenove as the lead financial advisor. When companies need help structuring deals, valuing companies, and negotiating terms, they hire investment banks. J.P. Morgan is one of the biggest names in the business. Barclays and Bank of America, Merrill Lynch, served as corporate brokers. They helped with the capital markets side, meaning they raised money and are managing some of these stock issuances. For the legal work, Will Gottschall and Manges handled the M&A legal counsel, and Bracewell handled the oil and gas specific legal matters. Deals this complex involve dozens of lawyers working thousands of hours. And on the seller side, LLOG, Guggenheim Securities served as financial advisor. Guggenheim's job is to make sure LLOG got the best possible price and terms. So what does all this mean for you? Deepwater Gulf production is growing while everyone talks about shale. The Permian Basin in West Texas gets all the headlines, but some of the smartest money and energy is flowing offshore to floating platforms operating in waters over a mile deep. This deal shows that international capital sees real value in American energy. A UK company just spent $3.2 billion to buy into U.S. offshore production. That's a vote of confidence in American oil and gas. And for Louisiana specifically, LLOG is headquartered in Covington. These are high-paying engineering and operations jobs. The deal preserves that presence while giving LLOG access to more capital to grow. $3.2 billion, cash and stock, bridge loans and term loans, lockups, escrow accounts. Now you know what all of that means. I'm Mark Roach, and this is FutureWise Energy.